Well, some of you will know me because I'm the advisory board chair for the doctoral training centre. So you'll have seen me in meetings and stuff like that. So,
I'm just going to say, great friend.
Yeah.
Just do that for us.
so thank you very much for all of these sorts of things. Now I got to figure out how to get this to change. Okay, so I'm a professor of finance. So why am I going to coming down here? And the answer to that is that 15 years ago, nearly 16 years ago, David here said that he needed to have somebody do something about finance to do some stuff when he was the senior scientific director at HP Labs in Bristol. And we started work on this sort of stuff all that time ago. And, I've got my name at the front here because it's just my talk, but a lot of the stuff that's in here is the lineage of 15, 16 years worth of work in the area of cybersecurity, working with great computer scientists like David, who have helped me understand a lot more about cybersecurity across a range of functions.
Sorry, I'm not really
Oh, sorry, you're a logician.
Nothing.
He's a logician, sorry.
I'm just quite hoping to know.
Yeah, yes, he's a logician, I could say. Okay, so be careful then to say it like that, but the reason I wanted to talk to you today was because for the last year and a half, I've been working with something called the Cyber Monitoring Centre, which has got a link there. Cyber Monitoring Centre is something that was set up by the UK insurance industry. It's a not-for-profit. It's a company, but it's a not-for-profit. It's also kind of engaged with government in the sense of government wants it to exist, but government doesn't officially sanction its existence, if that makes sense, because government wants to be hands-off. It doesn't want to have, it wants it to be something that the insurance industry has done. That being said, that several of the people who sit on the technical committee of the Cyber Monitoring Centre are in government. So there's two academics, there's myself and Sadie Creasy from Oxford, who I think they know very well. And I'm sure many of you know very well. And myself, Sadie does all of the sort of technical cybersecurity stuff, and I do most of the stuff is to do with like risk management and some of the things I'll talk to you about today. One of the big things that the CMC is interested in is understanding systemic cyber risk. And I'm going to try and sell you on the idea that systemic cyber risk is important. However, Henry is here, and he does a lot of work in systemic cyber security with this group called the Geneva Alliance, is it called? Association, yes. And they are a similar one, a European level one, which is looking at very similar areas, trying to understand when different types of events are systemic. So what I'm going to talk a little bit about today is why this is hard. It's like, it should be like a really easy thing to do. It's an easy thing to say, but it's like actually in practice, it's a really hard thing to do. But we had like a massive round discussion about Marks and Spencer's. And it's like Marks and Spencer's a really interesting case. Question is it systemic? And the answer, no, it's not systemic, but it's really important. But then the concern would be is, if you're labeling Marks and Spencer, which is a really big deal, and a massive impact across a lot of range of different activities, but it's not systemic. And certainly, public, journalists would say, well, what does it mean? It's really important. This is really important. It's on the newspapers and things like that. And so, yes, it's not a systemic impact. Something like the update crisis that Microsoft OEM did to Windows, now that gets pretty close to being a systemic event, right? This is a systemic event in that way. So what I'm going to tell you is, why we have, what would it mean, what we really mean by systemic, why disentangling what it means to be systemic is hard, how CMC looks at it, and then I've got a whole bunch of kind of like theory stuff that fits underneath it. And that theory stuff comes out of work that I did with David over the last 10, 15 years, which is basically about how we model in games attack and defense, and why the very nature of the relationship between the fact that we have a strategic antagonist means that the economics of insurance changes and that identification of systemic events becomes important. I've got a lot of slides with a lot of, game theory stuff on it. I'm not going to spend a lot of time on that, but I just want to show you that some good work has gone on over the last 10, 15 years to show that we kind of know, we know what the problem is. We just don't really know how to parameterize the problem to set these identification boundaries. Okay, so hopefully that's what I'm going to sell you today. If I'm unsuccessful in selling it to you, I'm going to shout at me afterwards. I'm happy to do that. And I can sort of try to tidy up any issues that I've left out. So yeah, so this is what we're going to talk about. We'll talk about measurement of systemic risk, a bit of an aside on how CMC does it. And, as I said, I think what we've decided on here is what we call the least worst approach, and why cyber is different and what it happens when you have a strategic antagonist who's there, because you can have quite sudden changes in the risk environment. So, risk. And from finance, we always think that we know everything about risk. Many years ago, I wanted to work for the Institute for Hazardous and Resilience as director. That was a sort of physical hazards group, mostly the geography, earth sciences, volcanoes, that sorts of things. And then I learned that actually I don't know anything about risk, and I completely need to relearn everything that I've done. I spent 4 years running this institute, and afterwards I came out and I was like, okay, now I need to understand a bit better about how I apply my learning from this time in IHRR to actually finance. And I've come back and a lot of the work is, a lot of the crossover work is always in insurance. Insurance is the thing which kind of maps the kind of physical cyber hazards type things to financial risks. And that's how we merge these two things together. Now, in finance and in financial economics, finance and insurance, we generally consider 3 types of risk: idiosyncratic risk, systematic risk, and systemic risk. And we have quite strong definitions for those two. What I want to show you is that these two, unfortunately, coexist and intermingle in a horrible way. And because they coexist and intermingle in a horrible way, this is what makes this identification quite difficult. So defining these 3, relatively straightforward. Disentangling these 2, quite hard. Okay? And the reason you can disentangle these 2, or these one versus these ones, is because of certain properties of statistics. But the other 2, much, much more difficult. So, insurance. It's really interesting. I promise. It's like, I know as soon as you think it's like, I got to renew my car insurance and my house and contents insurance and stuff like that. I think, we've all been there, filling in our forms and thinking how much. A lot of insurance that we don't have a choice about. Car insurance, for example, buildings insurance, usually a mortgage provider says, you've got to have your buildings insurance and these sorts of things. How does that work? Well, it means there's a regulation from government that says you need to go out and buy some insurance. You have to go. So you want to drive a car, you have to go buy insurance. If you have a mortgage on your house, your mortgage provider comes along and says you need to have buildings insurance. Don't care about the content, but you need that building insurance. This is a very typical part of your mortgage agreement. And one of the things that we spend a lot of time sort of thinking about is what we call actuarially fair insurance. For actuarially fair, you've probably heard about actuary, it's the person who's the insurance management for you. But actuarially fair insurance is usually defined as the insurance that is the break-even price for the insurance company versus the neutral risk of the underlying individual's loss that can be suffered in a bad state of the universe. Now, most of the time, we think about good and bad states, as in an event happens or an event doesn't happen. Now, clearly, there are gradations of events. So often what we're sustaining in our theory, to simplify it down to there's a loss, there's no loss. However, typically, there might be gradations of losses and things like this. And the reason we do that is for illustrative purposes. When we actually do the actuarial statistics themselves, typically we do them as a series of integral calculations that we have to kind of integrate over a range of different outcomes. What I want to show you is that in all of those cases, you can write those down in these kind of 2-state models. So you've got this branching tree, good state, nothing happens, bad state, you suffer a loss. That loss has some statistical probability attached to it. Okay. In the large, if you think about it across a wide population range, with lots of different losses, then this is how you end up sort of smoothing things out in that particular way. Okay. Going to think about two different concepts here. One is Q, how much you're paying for your insurance. That's your quote, using the American parlance here. And then you've got L, which is a little L, which is how much you get paid if that insurance comes out. And there's a couple of little results that you get, which is that if you expect to suffer a loss in a bad state, your house gets burgled, TV gets stolen, got a certain value to it, then typically you will always insure up to the maximum value. And there's a reason for that, which is just to do with the way risk aversion works. Now, I talked about three types of risks. The first risk is the easy one to determine. That's called the idiosyncratic risk. The idiosyncratic risk is the risk that's specific to the individual. It's the risk that you individually suffer that is uncorrelated to everybody else. Okay, so it is a risk, it is a component of risk for which you are uncorrelated to everybody else. So this means that in a probabilistic standpoint, within the little brackets that we have, that the product of your co-risk is always equal to 0. Okay, so if you come from a math background, that co-product is always 0. So this means that it's identifiable as being, for example, in this room, we all have, say, a 20% probability of loss, but each of those 20% is unconnected to anybody else. So your 20% is not conditional on anybody else's or the group or any other systematic factor in this particular setup. Okay, and that gives you the hint as to what the next one comes in. So idiosyncratic risk is that uncorrelated component. This is the bit that insurance companies love, because if you've got idiosyncratic risk, everybody's uncorrelated, then you can construct really good asset pools. And of course, the larger your asset pool, the more the diversification takes over, and the more that you converge on the very sort of good outcomes, quite predictable across a large population. So one of the things that pops out of looking at the individual isolated from everybody else is that if you are risk averse, then because of Jensen's inequality, again, a little piece of maths, you will always seek full insurance because it is always better to maximize the amount of coverage that you have. You are always happier if you maximize coverage because your certainty equivalent is always higher than your risky component. So this is a fundamental theory from Arrow and Pratt from the 1950s. And there's lots of experiments to show that that's just true. And in fact, you can do it with your own imagination. Picture you're purchasing insurance, you choose your coverage. Typically, you cover as much as you possibly can. You know, I know at one time I mentioned to my wife, Wendy, David knows, it's like, hey, I think we don't need to cover this, this, and this. It looks a bit expensive. I got shouted at a lot, so now we still cover it. So definitely that Arrow-Pratt theorem works for my wife. It works for me too, probably, almost certainly. You know, how many of you hire a car? Who here doesn't take the waiver? I always take the waiver. I mean, most people, unless you're really, really hitting the budget constraint, you take the waiver, right? So let's go talk about systematic risk a little bit. So systematic risk, this is when you have a common factor or a set of common factors. And so what are the set of common factors can be? Well, they can be lots of different things. They can be environmental variables. They can be things like the economic conditions of the country. They can be all sorts of different things, but you're going to have a vector of common factors that affect everybody and changes those probabilities in some systematic way, hence systematic risk. So in sort of like financial economics, we have something called the capital asset pricing model, which is a single factor model. In insurance, typically you have lots of factors. And you will all know this because if you've ever, when you have your car insurance, you have to put your postcode in, you have to put the model of the car in, all these things. These are all factors. Okay. And you can imagine, you've got we're recording this one, aren't we? So I'm allowed to say that. Imagine you have a Tesla. Okay. And the Tesla is a wonderful car and everybody buys Teslas and loves Teslas. But imagine something terrible happens to Tesla and they all basically go, because there was a movie, right? And all the Teslas were crashing. So imagine that happens, right? Single factor. Okay. Why? Because you've got this risk of a single factor, which means that you have some unknown vector of variables x, which affects your conditional probabilities. Okay, and that set is something that you're going to apply a model to. So you're going to work with model out. In the previous example, we were kind of model free, because all we had was a probability this is the state of the universe. Here now we have to have a model that describes what the factors are, and we have some uncertainty within that model, and we have to work it out with an expectation using simulations, and that's what insurance companies do. And they spend a lot of time understanding the factors that affect their risk, and they build up their particular systematic risk models. Okay, so here's a picture. This is what happens. Two populations, and I back the populations together. Once you get to 500,000, 20% loss. If everybody's idiosyncratic, it converges very quickly. But I'll show you an example where when you have a single factor model, then what happens is that you can get all of these different patterns of cumulative losses for a particular one. This is proportional loss per customer. So if you imagine for every pound that they put in, how much loss you're picking up. And of course, you don't want to be too high, which is the important thing from the insurance company's perspective. But this shows you the effectiveness of pooling. The more you pool, the tighter it gets to that single line. And you're happy because you charge a little bit of a margin and it's free money. That's how insurance companies work. Now, systemic risk. What is systemic risk? Well, the first and easiest definition of systemic risk is like my Tesla case. Basically, we all have Teslas and we're all a population of that. There is something that happens to all of us simultaneously. There is some probability of that happening to all of us simultaneously, and there is no benefit from pooling. Okay, there is no benefit from increasing the sample pool size. Why? Because we're effectively all one insured suffering from in that case. And of course, insurance companies don't like that because it means they're exposed to a risk factor which spreads across all the population. That's a contagion factor. Okay. Sounds simple enough. If I've got a socio-technical solution, you know, I've got clever computer scientists, I've got clever security people, I've got clever magicians. What do? I build a socio-technical model system. I try to identify my systemic factors and then build a model. The problem is the very existence of systemic risk kills insurance, because the whole purpose of insurance is the pooling compresses the cumulative density function down into a very tight line so that the more you pool, the more diversification you have. Okay? If you've got systemic risk, you don't get this. So despite the fact you can model it, doesn't mean to say that it's good for insurance. What tells the insurance company is this: don't insure that. Okay? Now, if you talk, there's a very nice guy called Stephen, who is the chief financial officer of Durham University. And he's a lovely guy. And I think I'll give it away to your procedure here. But we were deciding whether to buy cyber insurance. And yeah, but it's really expensive. And cyber insurance is really expensive. When you talk to a lot of chief financial officers, when they're looking at the decision making whether to buy cyber insurance, it's really expensive. And you sort of boom and ah about it because you're like saying, well, you might have liability coverage set to $100 million. That's and then the question then would be is, why is cyber insurance why is cyber insurance so expensive? And the answer to that is because insurance companies think that they've got a handle on the systematic factors and the idiosyncratic factors, and they're able to do this. But in the back of their minds, it's always there's something systemic. Something will happen. There's some SolarWinds-esque supply chain hack that could do something horrible to a large pool of to very large pool. And so this is something that has a problem. Systemic risk means that pool size cannot be properly priced. And because of that, insurance companies, if they believe there's any chance of a systemic risk problem, they will price it in literally up to the max. So you will pay quite through the nose for that. And this is something that is a concern. Okay, well, that's fine. We identify the systemic and systematic factors, try to get rid of those systemic factors. maybe put some exceptions in, things like this, and then do it that way. Problem. Big problem. The problem is that any systemic risk model can be rewritten as a factor model. And because of that, how do you identify when a systematic factor is a systemic factor and vice versa? Very, very hard. Okay, I'll give you a little example of a simulation I did. And this is just an example. So here I've got my nice, this is everything 20%, all 20%, just so we can see it. So what happens when I pull happily and I can compress it. The bigger this is, the closer it gets to that 90-degree right angle insurance company love. Okay, now I've got the systemic risk of 20% per annum. What does that look like? Well, you end up with this huge CDF that spreads over a massive range of values. Horrible for an insurance company, completely impossible. You basically have to pool, you have to have almost exactly the same amount of liability held in assets over the entire year, because you have to be expecting that at some given point in the next couple of years, in all of the contract, you will have to pay the whole lot out. Very expensive. Okay. Well, I can create a model with a systematic risk factor, which effectively just using a simple logistic regression, which matches exactly that systemic factor as well. So I have a systemic model and a systematic model, and they match it. All I need to do is have hidden variables that I didn't know about in the background for this there. It's got a positive coefficient in there, and then one day it's good. That's it in that way. So, one of the commonest models of this, for those of you who do any finance, is a jump diffusion model. Okay, that's a very classic one. Hawk's model, which David and I used for looking at contagion in cybersecurity a few years ago. All of these kinds of models do exactly this horrible thing. And as any finance person will tell you, as soon as you have any kind of jump variable in your system, in the probability system, you now have an unhedgeable risk. Once it becomes unhedgeable risk, pooling doesn't work, diversification doesn't work, you can't get rid of it, it becomes expensive, then you have to effectively charge almost the entire value of the at-risk portfolio and hold it in order to accidentally create insurance. So this becomes a problem identification. How do you identify when you have systemic risk versus systematic risk? Well, it's going to have to be on outcomes. You have to look at the outcomes of events and identify whether an event is systematic or systemic, and then come up with a way of identifying that and effectively removing that. So this is the problem that, as is stated. If you can do that, then you can come up with different insurance models, which then can be more fairly priced, reduces the amount of cyber insurance. And then if you have a genuinely systemic incident, well, unfortunately, this is something that society has to deal with as a whole. Okay, so like electricity transmission. So sorry, it's very, very dark. This is from Die Hard 2. For those of you who know Die Hard 2, there's this classic quote in there where Al, who's Bruce Willis's pal, he says, I got a bad feeling about this way. And then he says, ouch, when you get feelings like those, insurance companies start to go bankrupt. Well, same with systemic risk. You get a bad feeling about it. And if you do it wrong, insurance companies start to go bankrupt. So this is the sort of the core challenge. So why is cyber insurance special? So the question then is from a practical and theoretical construction, why is cyber insurance special? And the answer to this is that in most other cases, you might have a trend, you might have an impact in terms of your own personal behavior. So let's take buildings insurance. If you're careless with your building, if you smoke in bed, if you have one of those bar heaters and you drape your duvet over the top of it and things like that, if you do dangerous things, you increase your risk. Okay, that is definitely a case. So your personal behavior does impact your risk. If you don't make elementary precautions about flood risk or whatever these sort of things is, you also increase your risk. So you can have an impact on your personal risk. So your behavior can change your risk. If it's about buildings insurance or contents insurance, leaving your door open changes your risk. Okay, but the thing in most of those cases, and maybe the you could argue with the thieves it's slightly different, is that the background risk that you're sort of fighting against in terms of trying to adjust your behavior to reduce risks, it doesn't change very much, okay? Climate is a risk. We have this oscillation and it has a trend because of climate change, but it is a slow moving reaction. And generally over the life cycle of an insurance contract in terms of years, this is something which you are measuring the individual response, but you don't need to measure that environmental component, okay? Now, that means that you can probably model this using standard actuarial statistics. You just have some extreme events, because you might have a cluster of events. It's very famous from the late 1980s. We had Hurricane Andrew, Piper Alpha, and Pan Am 103 all at the same time. It's probably something that those of us in our 40s and 50s remember. And Lloyd's of London got absolutely hammered. And there were these names, the Lloyd's names, who were told that they could get free, high rates of return, but they had to underwrite the pool. And then they had this bunch of disasters, and these names all got wiped out. The whole holdings got wiped out. They spent ages trying to recover it in the courts. I feel particularly sorry for them because the contract was pretty clear and they were getting a lot of return on investment earlier on, but they were taking risks. Now, the thing is that you can get clusters of events like that sudden thing that happened between 86 and like 89. But typically, you can model these using standard extreme event theory. The problem with cyber insurance is that the attacker is patient. The attackers are strategic. And so you can have a background level of risk that you're measuring in some particular way, and the level of events might be very low. But all of a sudden, you suddenly get boom, they're piling in on you. Okay? So this means that looking back at historical data to parameterize these extreme events is a bit dangerous. Because the strategic guy knows that you're measuring these things, and so he knows to do things in a way that counters how you're measuring that. If somebody's after your firm, what you're trying to do, well, you're patient. Okay? The first time that you see a hacker in your system, the first time the ransom note comes in and says all your stuff is there, they haven't been in there for 10 days or 3 days, 5 days. They've been in there for weeks and months. Okay? And this means that the patient attacker, an attacker who's really careful, is going to be quite a dangerous adversary because your risk can suddenly change quite high in a short period of time. And even if you think about it in terms of thieves breaking into your area, it's kind of hard for them to attack a large number of houses just simultaneously, without actually somebody noticing, things happening, right? So cyber is a different case because you can have a patient attacker who is gradually building up a portfolio. And the SolarWinds, I think, is a really great example of this. They went in through a supply chain hack. They gradually got themselves into lots of different places. And that could have been a really nasty environment. The Microsoft one is an accident, but you can see how all of a sudden things can spiral out of control very quickly, just snap, in one case. That wasn't an actual cybersecurity incident. That was just a bad coding, but it's bad coding that illustrates how much you can break stuff really fast in a cyber context. So into this interesting mix as to why insurance is important, why systemic risk is measuring it and trying to understand it is important, comes this cyber monitoring center. And so what's the duties or the job of this place? Well, it's to measure whether events are systemic or not, and to give them some kind of grade, and to give them some kind of classification in this sort of ways. And it's kind of important from that context to give an understanding, to allow some kind of background information to propagate across the industry in the risk management context. So what happens when we do an event? Well, it's quite interesting because you kind of get a phone call and you get a call and it's told, there's an event. Okay, and the event becomes known, something's been published, or there's a new, or something sort of, comes out of the security apparatus that says that there's an event, usually just watching the news. And what then happens is that that happens, the technical committee gets scheduled, and effectively we all have a call, and then we decide whether we're going to investigate the event or not. So we have a sort of preliminary phase to try and understand whether an event deserves to be investigated or not. And we then tell anybody who's interested, which is usually mostly the insurance industry, but also government, cybersecurity, these sorts of things. We tell them if we've decided to go and investigate a particular event. Now, I should say that we only really look at big events. We don't look at small events. We usually look at least prima facie big events in these ways. What we then do is we start to do data collection. And there's a whole team in about 4 or 5 different collaborating institutions that then begin to collect data. There's some information that we can get to see whether there are claims coming in. There's some information we can get which is from public domain. And we also have, so CMC has also bought different data sets. So for example, in retail, we have some data sets which allow us to see how many credit card transactions there are. Let's see. Okay, so this is something that we do. Once the modeling has been done, we then make a public statement on what the classification will be. And then there's a sort of technical committee workshop to figure out whether we did the right thing or the wrong thing, and whether we've got people from that particular company effectively shouting at you or happy with you. Sometimes, I mean, they could be very happy with you because if you sign off and say, look, this is a pretty valuable, this is something that they couldn't control, this is something that's outside of their environment, outside of what they could be looking at, then they can be quite happy to help out in that. I mean, all of the businesses who've set up events so far have interacted with us on this sort of thing. So this is how we operate. And then the question then would be is like what we do. So this is our sort of scale in terms of our categories. It's like a hurricane. And so we have a kind of category 5 at the top. This is your systemically important event. And that says to us that we need to have at least 5% of the population of the UK is affected. I should say this is a very UK thing. Okay, very UK. All of this is on the web, by the way, so it's available. The links there. So everything here is public. And in order to be Cat 5, it has to be 5% of the population, but it has to be over 5 billion in this way. So we have this kind of logarithmic scale coming up here, and logarithmic scale coming across here, which is very similar to how we classify earthquakes and wind and that sorts of things. So these things getting sort of exponentially more powerful in that sorts of ways. And then what you find is that if you delve deeply into most events that you see, they'll be high profile, but almost all of them operate in this lower quadrant here. If the Microsoft debacle with CrowdStrike had been a cyber attack, that would have pushed us quite close up to category 4, but it wouldn't have quite probably have got us right into category 5. So you're talking about a problem that's greater than the CrowdStrike impact there, because we did a sort of preliminary measurement of the CrowdStrike one, assuming it was a cyber insurance broker. So we look at a combination of things like direct, so we model firms. So we look at their cash flow, and we make some assumptions on disruption. Sometimes we ask them how much disruption that we have, see how things like daily turnover. Have to be careful with retailers because they do like 40% of their sales in the 2 weeks after Christmas. So, you can't just provide their cash flow all the way over the year. Sometimes the companies are very nice, they just give us this is how much disruption we have. In other cases, we basically sit down with Orbis Business Intelligence and we pull the company to pieces, we make some assumptions and come up with a number. And then we do that for every single company that's affected. So I'll show you a little graphic about how we do what we call the cohort analysis. And we create this thing called an archetype. And the archetype is a typical company affected in that way. And then we classify how many companies would have been affected in that way. We usually try to go to the chambers of commerce, and they run they're quite helpful. They run a survey with their director and their institute of directors. And what they'll do is they'll run some surveys and they'll ask how many people have been affected by this. And then it also gets some information back about that. And you won't believe it, but there's really quite good survey response rates, 70–80%, really good survey response rates. Not always, but like really good. People are quite keen to be participating in these sorts of things. And then we also talk to government as well. So government can also provide quite a lot of helpful information on there. And in some cases, we talk to other universities because there's a huge amount of knowledge in academia about different kinds of events. Because you can imagine we're dealing with lots of different types of events. Sure.
So I'm surprised that incident didn't go on at 5. So would this be a global assessment or?
No, this is only for the UK.
Okay.
So yeah, if it was a global assessment, then these numbers have to be a lot larger.
I see. Yeah.
Yeah, it's talking about 5% of the UK population affected and 5 billion. A lot of that's informed by the UK government's own sort of catastrophe risk modelling, like what happens if a gas explosion ends. They do a lot of this work to try and figure out what those kind of classifications are. And typically the ones at the extreme end are crazy stuff like nuclear meltdowns, that sorts of things, really extreme things which are terrifying to see. So our Cat 5 is not quite as terrifying as that. That Cat 5 in that case would probably be like all of Marks and Spencer's, Tesco's, Sainsbury's, Morrison's, and Asda don't run for like 3 weeks. That would be a Cat 5. So it's not nuclear warfare. It's just that we can't get fresh awareness, but we actually can get into some projects. So, Cat 5 in cyber is never as severe as Cat 5 in real government, shall we say? Because Cat 5 in real government is like really serious. So I never want to make too big a claim on this one in this sort of ways. I mean, these are very serious events. I mean, the hospital event where there was a hack and they were basically locked out of the blood assessment ones. That ended up, I think, as a Cat 3 because the spin out effect across the NHS was catastrophic for a week. And that mostly was there on the basis of that it was easily affecting 1% of the population of London, for example. And although it was dicey as the numbers, so I think if we were being really, really, really aggressive on that one, it would have been Cat 2, because it never got, it's close to the 100 million mark. That's only if you did a lot of opportunity cost calculations. Physical cash flow cost, less than 100 million. Opportunity cost, over 100 million. That's how it crawled into the Cat 3. But the size of the impact, because it had this massive impact across, it was such a central blood assessment hub, that was kind of important. So this is kind of how, this is basically answering your previous question. So effectively, this is how the data is collected. There's some really useful stuff here. So we have the ONS as part of the group. You've got parametrics is a really, they have amazing data. You've got 2 people, senior data scientists from the NHS, and got lots and lots of data providers who can feed into this stress testing. And Ruth, who's our chief data person, is a machine when it comes to gathering that up, which is sort of hoovers it all up. So then you have just us.
So there may be organisations, for instance, banks, who run and say to build that into their business models that they have to account for losses and the like, but they don't publicise it. Now, is that
under the NIS directive, which we are, the Data Act actually puts us to, then large institutions of a certain size have an obligation to report through their regional incident reporting center some information about impacts of these sorts of things. They're not allowed to keep them secret. So do they publicly, do they go and advertise it in the Daily Mail and say, hey, we've had this thing? No, but they do have to inform the relevant authorities. It's not just a GDPR thing. So the NIS directive sets up these regional incident agglomeration centers, and every country has to set them up. And then effectively there is some obligation to explain what's happened. It's not as good as one would like because they don't have to put financial values on it. But typically, if you are still provide some information on that, as long as you're not broadcasting, so we have to have some care when talking about certain things, because if it's a single company event, then clearly it's easy to back out where the losses are. In a multi-company event, it's much more difficult because you're giving an aggregate figure. And once you have more than about 8 or 9 companies involved, then it's impossible really to kind of back that out. Anything with the NHS is just massive numbers, because the NHS, if it was a business, would be easily one of the largest businesses in Europe. And it's just a massive enterprise, the NHS. So as soon as you have anything with the NHS, then that's a really big numbers. But as you say, banks, they have some reporting requirements. They're not allowed to keep certain things secret, but they don't provide exactly the detailed information. It would be lovely if there was some, pretty secure database that, GCHQ could hold that would basically allow us to do this aggregation really quickly, and that all, UK registered businesses could just feed in and anonymously. And as long as there's some kind of obligation to protect, by not releasing data, that you could then construct this aggregation. That doesn't exist. You do have to do some modeling on that. It's not 100% perfect in that ways. But I think what is developed by the data analytics team is about as good as you can do, given how we collect data on this, given that, everybody subscribing to the NIS directive is honest. So that helps us, not maybe with the financial side, but it helps us with the affected population, right? So the other bits we can start to back out in this particular way. As I said, we build these things called archetypes. This gives us a typical firm, which can be then affected. We then construct templates for each firm, and then some poor guy has to go and fill all of those in, and they have an army of interns and various other people who have to do all this work, and it's quite a big job. And then our data scientists have to, the CMC data scientists have to do that. We then, as a technical committee, consume that information. I can see Tristan's going to be laughing there, because it's like, normally I'm the one delivering data and not the one consuming data. Yes, I have to read a report. It's quite sad. It's many times I look at this and I'd love to have a look at that data, and it's like, no, you're not allowed to. So, this is kind of an interesting part of the job. So that is what the CMC does. How much time have I got left, by the way? EJ? 15 minutes. 15 minutes, yeah. So what I'll do is just, in the last 15 minutes, I'll show you that we actually do some science, and that there is some usefulness in terms of, there's some disciplined modeling that sits underneath it. Is a phrase I've stolen from David. He did this phrase once, I think we were in Brussels, and I like it so much that I use it all the time. And there's some disciplined, proper modeling that sits underneath it. We should show you that we do this properly. So cyber insurance, I think most of cyber insurance, it's usually a corporate liability insurance. It can come packaged with standard corporate liability, or it can come packaged separate. So there are two kind of branches of it. Pure corporate liability with cyber insurance is usually to do with, like, when you've done something wrong, like you haven't secured your system and you're liable. That's particularly common in the United States. You can imagine in healthcare, you can immediately get sued if you've lost data. Even if somebody else has stolen it, you've got to show that you protected it in a critical way. It's actually quite hard. So that's that sort of liability side. On the separate side, there's the sort of the pure, you're getting paid if you get attacked. So it's your sort of victims insurance in that way. And that's got slightly separate set of clauses and schedules in there. And in fact, small bits of sort of gratuitous advertising. There's a fantastic paper in the Journal of Cybersecurity from a few years ago, which analysed all the schedules of every cyber insurance policy in the US. Trying to remember the guy who was the lead author on it.
That's a really nasty. That's a really nasty. Be careful with that, because it only comes the admitted market. It's actually a small part of the insurance market.
but it's the publicly available data.
That's true.
Yeah, and what I like about that paper is it allows you to see the kinds of things that they're worried about. So it gives you a kind of an idea. As Henry says, don't take it as read as being that's the proportions of stuff, but it gives you a list of a sort of a textual analysis of the things that they worry about in these schedules. And as I said, there's this kind of separation between that liability side and that you as a victim side. So you're going to have CERT.
Generally bundled these days by a cyber insurance policy that's covering liability and system failure.
So you get, yeah, exactly. As I say, you have the CERT, you know, emergency response team. You're going to have the, you know, reputational damage, which they'll do some estimations on, disruption, insurance, various other bits and pieces for this. So, and as Henry says, these are in a package. You buy them with the package. And the last information we had was that US cyber insurance public market is about 2% of the total corporate reinsurance market. And it's getting bigger. This number was 1 billion only about 4 years ago. So
About 15 now when you
just gets bigger and bigger and bigger.
best course of knowing is the insurance brokers.
Mhm.
They see all the policy bundle them up. So it's like I can't be like the Aon, whoever, about 15 billion is investing now.
The thing that's interesting is, as I said, 1 to 8 to 15, let's take that number from 2024. One, you know, this is a market that is growing really quick. And as I said, you know, my CFO comes to me and says, cyber insurance is really expensive, but I think we should buy it. And I'm like, yeah, what are you going to think about it? Because, you know, I'll show you in another couple of slides that actually you have to buy it. I mean, once everybody starts buying it, you really have to buy it for various different reasons. And that's just how the market works. If you're trying to self-insure in a fully complete cyber insurance market, you are effectively creating welfare issues for yourself in that way, as it's not consistent with it. So, what does it look like? I'll just go off. I'll skip through a little bit in this, because I already talked a little bit about why. What is the advantage of cyber insurance as a market? Well, about controlling risks. So cyber insurance, typically when you take out the policy, they're going to ask you to do certain things. Otherwise, they're going to charge you a lot of money. So there's going to be certain specific identities of stuff that they're going to want you to do. Access control, different ways of securing a system. They're not going to say, we're going to just turn up and say, relax, you're insured, just don't care about it. They really want you to do stuff, and I'll show you again why they do that, because it's massively in their favor. Because they'll charge you against the background risk, but if they can reduce your individual risk to be much lower, and obviously they're making a lot of money off of that. And that comes from that factor construction I was telling you about earlier. So, does insurance improve your welfare? This is the first part I was going to say. Absolutely, yes, it does. If you're risk averse, everybody is risk averse. I don't care if somebody here says, I go parachuting every Friday. I used to go parachuting every Friday. I still don't want to die. Everybody is risk averse, particularly when you're making, you know, any kind of major financial decisions. Now, technically, companies are supposed to be risk neutral, because when we model companies using the Monte-Carlo Miller rules, which is this kind of famous way of looking at corporate finance, we treat the company as risk neutral. No. Every piece of evidence that we have from management directors all the way through shows that the way companies actually operate is more risk averse than the collection of individuals that make up their board. If you collect the individuals that make up their board together and you isolate each individual person, they will have a certain level of risk aversion. If you collect them all together, the company's observed risk aversion will be higher, or at least as high as the most risk averse person on that board. So companies typically take quite a lot of measures to protect themselves from risks. And one of the reasons for that is because of audit. Because audit is incomplete, it's difficult for a director to prove that they've done everything they could possibly do to protect their company from harm. So therefore, insurance is the way to do it, because that's the way of evidencing to their shareholders that if harm comes, then those shareholders will be compensated for that particular harm. Where does this come from mathematically? Well, if you're risk averse, you have a complex utility function. That's just the way the economics saying that you don't like risk, okay, and that you won't take a fair bet. then what happens is that your difference is the level of premium that you're prepared to pay. So the level of risk aversion tells you how much you're willing to pay to fully rid yourself of a particular risk. Okay, and that can be quite high. There's evidence from the United States of people insuring their houses that if you look at background risks, people are willing to pay way more than you would expect if you were just looking at it in a sort of standard way to actually rid themselves of risks of certain types, particularly things like life insurance and stuff like that. So if you look at these actuarially fair rates of insurance, then if you're offered actuarially fair insurance, you always take it. If you're offered more expensive than actuarially fair insurance, you almost always take it. It's until the insurance becomes so expensive that it hits your risk aversion threshold, then you stop to take it. So does insurance improve your welfare? Almost always, yes. Okay. And there's like 50 years of research in insurance that talks about this. So cybercrime, talk a little bit about how cybercrime works, but I already spoke to you about that beforehand. And trying to understand what the behavior of targets is, what the behavior of firms are who are being attacked, how to provide this insurance. So we've seen lots of things like cryptographic attacks where there's an encryption of the data, disruption, these sorts of things, and obviously just stealing stuff. So when you're making assumptions about how you do it, what you want to do is you want to build a game. And you're going to have a game, and you're going to have three main types of agents. It's going to be a three-player game. It's actually going to be a large player game, large number. So you're going to have targets who are firms. There's going to be a big cloud of those guys. You're going to have attackers, and they're strategic attackers. They're making strategic decisions. There's going to be a big cloud of those guys. And then we're going to have a regulator or a public policy maker who's basically trying to manage it all and trying to maximize social benefits. So we're always imagining a benevolent social plan, although as most of us know these days, it's very difficult to trust government to be a benevolent social planner. But, this is Jeremy Bentham. He invented the idea of the benevolent social planner. So we'll conceptualize it in a sort of more firm way. So in the heart of UCL, in the spirit of Jeremy Bentham, we're going to assume a benevolent social planner. So what does it look like? Well, you've got this cloud of targets. This cloud of targets, in certain cases, will have a risk posture a priori in the absence of insurance. So imagine there's no insurance. So that will lead to a natural equilibrium outcome. And if you're relatively benign about your assumptions, so you assume each target has effectively a concave utility function, they're risk averse, they have some sort of ability to control risk. That ability to control risk means that the more investment you make, the lower your risk is. We'll assume that function is relatively smooth, although you could argue that there are step changes in that which make it not so good. But if you assume these things, then you get this nice natural equilibrium, which is your point A. And this is where you have your highest level of investment in cybersecurity. Now, what happens is that if you maintain your investment in cybersecurity and then you buy cyber insurance and everybody else does exactly the same thing, what happens is that you move from point A to point B. And as you can see, that is a massively higher level of welfare than point A. And you can measure that, it's a considerable change. Not that you're supposed to worry about the magnitude of the change, because really in these utility things, any higher utility is what you accept. But in a standard framework, you get a big welfare benefit by taking insurance, assuming that everybody makes these investments. Now, the interesting thing about this is that once you have B and you bought your insurance, getting out of the insurance is not good. And the reason for that is that if you unilaterally decide to sell your insurance, or decide to get rid of your insurance and don't insure, then you move to point C, which is actually worse than where you were if everybody was effectively managing their risks without any insurance at all. The other point about it would be is that a monopolist insurer, if it's not a competitive market, and I know Henry will say it's a very competitive market, very, very good. So definitely at point B. So you provide you with a nice actuarially fair contract. but a monopolist insurer can actually push you all the way to point C, and you will not reject the insurance because you would still be worse off going to C minus 1. So effectively, once you're in insurance, you don't leave. Okay, you don't leave, you don't want to go out of it. And if you do go out of it and there's a sudden change in those factors, you can be massively exposed to a higher level of risk. You know, you don't have the insurance to help you, to pay you off, and you're exposed to all the attackers going, we'll go for you. Okay, so this is a bit of a problem. There's also an issue, which is when insurance happens, in many cases, attacking intensity will increase. 2 reasons. One is when targets become risk neutral, they reduce slightly their investment because they're risk neutral instead of risk averse, because they're taking insurance and now they're effectively hedged. So at that point, they become risk neutral. So the equilibrium level of investment relative to what they should be investing is down because they bought the insurance and there's a little substitution. But the bigger effect is that the potential payoff for attackers increases. Why? Because they know that companies are going to have insurance, so they know that they can ask for payouts off of that insurance. And we've seen that with effectively with the ransomware attacks, because effectively they want companies that have got insurance because they say, hey, why do you worry about this? Just pay us. Okay. Marks and Spencer's was asked, I think I did say it, 50 million for releasing their stuff, right? Already cost them 300 million by saying no. And they had a 100 million insurance contract. It's, if you're a Marks and Spencer shareholder, it's a hard one to say. Now, I fully respect the CEO of Marks and Spencer's work on not budging, right? Absolutely, that's a great thing. But 15 million versus 300 million is quite a big change, right? So one of the things that's nice about this is I think it's a long time before Marks and Spencer's, but that Marks and Spencer's example is exactly the C minus that we sort of say there, right? You're getting absolutely canned. You decided against paying your ransom and you got a bit hammered in that way. So there's a lot of kind of modeling that you do when you do these sorts of things, just to sort of show how this works and the fact that it works mathematically. And it's easy to say if something works verbally. I can always say, well, it's like this, it's like this, it's like this. And again, so quote David, if you can't write it down as a model, then what do you say, right? Because there's got to be some hard logic that sits underneath it actually working it out. You know, if you write down a risk averse function, you can't find the effect that you're looking for, then you're really kind of not being honest with your audience. You can say, hey, I've got this thing and I fully explain it with my theory. But if you can't write your theory down in a way that actually makes sense from a utility framework or from some modeling framework that you put in, and you can't show that it exists, then really, you know, your theory is not really a theory, it's just a sort of a series of statements, right? In that sort of way. So a lot of the work that's in here, and there's a couple of, we've got about 4 or 5 papers on this now, and this is basically the summary of that, is that when you have attacking cloud, the attackers make strategic decisions, defenders make strategic decisions, the equilibrium works, and we get a lot of the effects that we see in practice, and we can try and disentangle where they come from. This big one is the attackers. The attackers make a huge difference. The fact that they act strategically, the fact that they react to the presence or the absence of insurance is a big and important thing. And that's what cyber insurance is different. And that's why I would argue cyber insurance is a great area to research in. And I sort of come to an end of my part here, because otherwise I'll take you through policy experiments and various bits and pieces. But effectively, the summary is that you always choose full coverage. You don't want a monopolist insurer, and you do want some regulation of the area. And I think those are the key things that are there. And there is solid work there that's been published for many years from large number of people, including people in the room like Henry, that have actually shown that. We've got a body of literature in the economics of cyber insurance, which is building now, which started, I don't know, with our friend in Austria, what's his name? You know, Reiner and Co, Reiner and Schwartz. And they started this off a long time ago. And, this is built up over time, and now we have a very deep set of theories across a range of areas. I would argue that what I'm showing you here is the most general, because there's no assumptions on the nature of risk aversion, there's no assumptions on the structure of how attackers react. All we assume is that more attacking is bad, and it's bad in certain directions, and more investment is good, and it's good in certain directions. You sign the various different derivatives, solve for it, and you can show that all the effects that people like Henry, Reiner, David, all these other people have done over many years with different kinds of functional forms, they're all totally valid, and they all show exactly the same kinds of effects, which is, it's very important to have cyber insurance, but it's also important that we don't have a monopolist, and it's very important that we have some regulation. And it's also important that we understand that the attackers are a key component of that, and that modeling cyber insurance just on a statistical basis on background distributions can be a bit dangerous because of that change. So I sort of leave it there a little bit, because otherwise you spend a bit too much time looking at maths, and that's not really interesting. So I'm super happy to take any kinds of questions. Yeah. Henry, go for it.
No.
This is his revenge now.
It's not my friend, and this is a classic different one. Let's say this question emphasizes. But in the analysis, the models have shown assume that companies buying insurance directly interact with the insurers, which in the real world, of course, they don't. And personal lines, customers interact with the insurer via a web platform, you shop around, you use price comparison websites. The commercial insurance world, you have to buy a policy via an insurance broker.
Yeah.
And the brokers actually act effectively like a clearinghouse for information and prevent any one insurer from being monopolistic, because they are regulated and they have to guide, they're regulatory duty to guide their customer, the insurance buyer, to the best policy that in terms of terms and conditions, costs, fits their needs. And then you can have a very interesting set of circumstances, which is what we're currently seeing in the cyber insurance market, is something is, which is where actually required more competition, rates are going down, and actually brokers can end up driving insurance companies to write policies that are below what they think should be the actually fair premium, because otherwise they lose their revenue stream. And then you find all things in an idealized world, they would not the risk, they end up basically applying an excessive discount factor to those remote risks.
I have a quote.
But I'm wondering how you would unpack all that.
Yeah, I have a quote. Financial Times 2012, it's my favorite quotes. Well-regarded insurance analysis, they declined to be named, said the ideal scenario this year is we have some hurricanes. Okay, absolutely. And there is a problem of companies will look at, and I say this having working for an organization that has this kind of problem, that will look at the statistical distribution of attacks on their own infrastructure, and will say, hey, we don't need cyber insurance, it's kind of expensive, because we haven't really had any attacks, and nobody seems to care about us. And I have a feeling that there was probably somebody in marketing expenses thinking about that a few years ago, right? And I don't say that insurance isn't important. As I said, insurance is hugely welfare improving if you have an understanding of the ambient risks. Remember, these are all full information models, right? Whereas in the real world, we're working partial information. So it's electrical information, very difficult to model. You always then have to make some assumptions on how information is propagated, and that's a real problem. The only thing I say to you is that the monopolist is bad, but I think we're all agreed that monopolist is bad. The question is, how bad is a monopolist in the cyber insurance framework? It's pretty bad. In fact, there was a hilarious paper a couple of years ago from a guy at Princeton who said, hey, and he was, he came from one of the kind of technical units and hadn't thought about economics. And he said, there's a paper called How Security Companies Can Make Excess Profits by Providing Cyber Insurance. And what he showed was, in a standard modeling framework, the security company and the insurer you can really break your huge excess from this. And I mean, I felt very sorry for this guy because he got absolutely pilloried. And his paper is kind of the subject of a bunch of jokes now, like, you know, like, why would you say this? But, and that's why I won't name him either, because he's going to have to look it up. But it was so bad that I was asked to submit a paper on a review to IEEE Security and Privacy. And I put this paper in, and the editor circled it and said, you can't put that in, it's kind of obvious and stupid. I said, yes, but people read it. And it's actually got like traction, and they went, oh, this is a really good idea. Brokers, I mean, obviously within these models, we don't have a cheap talk kind of intermediate broker model. So we assume that, we assume you really need a broker because all insurance companies provide insurance in that model have full information, of course, available information. So you do need to have that broker sharing that information around in that reinsurance market to show full pooling, because that's how you provide actuarially fair insurance. And I don't say anything bad about the insurance company. I say it's absolutely necessary that we have cyber insurance. I think the main thing that I would say to people is that if your CFO is worried about the cost of cyber insurance, remember, statistical analysis of previous cyber insurance is not a good forecast on it. Okay? You have to be very wary of that. Why? Because your antagonist is strategic. Okay, it might be that he just couldn't be bothered with you at this point, but if something happens in the future and they can't be bothered with you, then it's like locusts, they're going to be on you. I mean, there was an example I saw from one company that kind of went public and they had a bit more viability. The number of attacks that they had on their infrastructure just exploded. Okay, just exploded. And you know, these sorts of things are kind of you know, quite interesting on that sort of front. So I think that, you know, my answer to your question is that, you know, I think I answered it in the talk, is that, you know, cyber insurance is important, information sharing is important, but my argument is less about that fundamentally. It's more about we need to measure systemic risk, and if we don't measure it, we'll break the insurance contract for exactly the reason that you're talking about. The insurance companies worry about that systemic risk; they want to price it in. The brokers are saying no, you've got to do it, and you know, we go back to Al. You know, if we keep doing that, something bad is going to happen. Okay, something really bad is going to happen. So, you know, we do have to be careful on these sorts of things. It has to be fairly priced. It has to be fairly priced to improve the welfare of companies, but it also has to be fairly priced so that we don't end up with sudden systemic events in that way. So that's why I think measuring systemic risk is a really important part of it. And I think this is a sold argument, because you can see that supranational bodies across the world are seeing this and saying, yes, we need to do that. Okay, I mean, admittedly, the US government at the moment is kind of a little bit weird and they don't care about. I mean, you know, they stopped funding the CVE. Imagine. They stopped funding MITRE with the Common Vulnerability Committee, and it has to be supported by the private sector. And it might be that the Chinese vulnerabilities database is the only proper vulnerabilities database at the moment. That's some scary stuff. Huh?
EU have got up and running. It's not bad.
But it doesn't, you know, that's the national vulnerabilities database. I mean, it's just like supposed to be you know, that's like part of the furniture, you know? The fact that we suddenly have to go, oh, let's go create our own, you know, and they say, oh, it's up and running and it might be pretty good. I mean, that's the NVD. Okay, so there's a little bit scary about the US government's commitment to open policy in this area, you know.